If you have soybeans sitting in the bin or unpriced bushels standing out in the field right now, stop what you are doing and look at who just walked away with yesterday's 45-cent rally. The board lit up like a Christmas tree on Monday, with November beans skyrocketing 44.5 cents to settle near $11.92, and December corn surging 16 cents to close near $4.58 a bushel. And as we sit here on this humid Tuesday morning, July 7th, the market is catching its breath. December corn is down a quarter cent at $4.57.5. November beans are holding on to gains, up a cent and a quarter at $11.93.5, while Chicago and Kansas City wheat are giving back 2 to 3 cents. The bulls are parading around, celebrating China's sudden return to the U.S. market. But quite frankly, if you look under the hood of yesterday's trade, the guy sitting in the tractor isn't the one cashing the check. In this video, we are going to break down the backroom math behind China's state-owned grain buyers, reveal the 46-year heat record the USDA is completely ignoring, and show you exactly why holding your old crop beans for $13 could be the most expensive mistake of your farming career. I want to know what your local elevator is doing with your basis right now, so drop your city and state in the comments below and tell me your cash bid. Before we expose the inflation trap waiting for your 2027 budgets, make sure you hit that subscribe button right now. You need to be subscribed because these grain markets are moving violently on weather shifts and computer algorithms, and nobody at the local co-op sends you a letter in the mail when the funds decide to pull the rug out from under this rally. We give you the straight numbers and the cash marketing reality before the deadline hits. So hit subscribe and let's get into the data. Yesterday's explosion in soybean futures was fueled by news that Chinese state-owned grain trader Kofco finally returned to the U.S. market with its largest purchase in months, scooping up at least 5 cargoes, which is roughly 300,000 metric tons of U.S. soybeans for shipment between September and November. Traders behind the scenes are whispering that additional deals are currently being finalized, with total purchases potentially reaching 600,000 metric tons. If you look at the White House fact sheets that came out over the past year, China agreed to purchase 25 million metric tons of U.S. soybeans annually through 2028. Up until yesterday, U.S. bean exports to China for the current marketing year were running a disastrous 47% below last year's pace. Now you add in the news that President Trump is expected to meet with Chinese President Xi Jinping in Washington around September 24th, right when combines start rolling across the Midwest, and the speculative funds decided it was time to cover their shorts. When you look at the commitment of traders' numbers and daily fund trackers from Barchart and Reuters, large money managers panic bought roughly 10,000 soybean contracts and 36,000 corn contracts in a single afternoon. Wall Street algorithms smelled weather fear and political headlines, and they bought the board with both hands. But here is the salt in the wound for the American grower. While the futures chart in Chicago looked fantastic yesterday, grain elevators across the country quietly adjusted their basis. When paper prices spike 45 cents in one day, the physical handlers often widen the basis to protect their own margins, meaning the actual farm gate price you receive doesn't reflect that entire rally. Wall Street captured the paper move, while the grower on the ground is left dealing with the physical reality. And that brings us to the weather in the Corn Belt, which is turning into a massive crop scare event. The USDA National Agricultural Statistics Service came out with their crop progress numbers and rated the U.S. corn crop at 67%, good to excellent, completely unchanged from the previous week, while soybeans sat at 64%. To hear NASS tell it, everything is fine, and we are marching toward a mammoth crop. But our friends over at Crop Profit ran the actual temperature data from late June through the 4th of July holiday, and what they found should send chills down the spine of anyone short this market. U.S. corn production weighted minimum overnight temperatures just ranked as the #1 warmest stretch of the last 46 years, breaking the 1981 to 2026 record with overnight lows averaging 69.6 degrees. It is not just about daytime 90-degree heat. When overnight low temperatures stay parked in the 70s during crucial pollination and silking windows, the corn plant never gets a chance to recover. Modern genetics are heat tolerant by all means, but 46-year record overnight heat is going to ding yield across Illinois, Ohio, and Nebraska, regardless of what the government reports in July. I want to hear from you guys with boots on the ground right now. Are you seeing leaf roll and pollination tip back in your area, or is the crop still looking road pretty where you farm? Let me know in the comments, because field reality is starting to diverge hard from government estimates. Here is the bitter truth that nobody on Wall Street wants to talk about. Even with soybeans trading near $12 and corn pushing toward $4.60, the American farmer is getting raked over the coals by the purchasing power of the US dollar and relentless input inflation. Ag analyst Chris Barron recently laid out hard farm budget numbers, showing that we are staring directly down the barrel of another major wave of on-the-farm input inflation going into 2027. When you factor in the skyrocketing costs of machinery parts, diesel, property taxes, and chemical programs, today's $5 corn only buys what your father's $3.50 corn bought 40 years ago. An $11.90 soybean today is a historical mirage. If you are sitting around waiting for $13 beans just to feel good about your marketing, you are letting emotion run your farm business while fertilizer manufacturers prepare to eat your margin next spring. So here is the read, and exactly what you need to do with your bushels right now. Do not let greed or political optimism turn you into a spectator during a crop scare rally. Historical seasonal studies prove that summer weather rallies driven by 14-day Euro models and Chinese trade chatter have a strict, unforgiving expiration date. Once rain finally hits the eastern corn belt, or the funds finish their short covering spree, these markets can drop 20 cents faster than you can call your grain buyer. If you still have old crop corn or soybeans sitting in storage, use this pop above $4.50 on December corn and $11.90 on November beans as a mandatory cash sale window to clean out your bins and stop paying interest on stored grain. For your 2026 production, you need to be aggressively benchmarking your break-even costs right down to the penny. If today's price locks in a profitable margin over your actual production costs, execute incremental cash sales, or put floors under your crop using options. Do not wait for President Trump and Xi Jinping to shake hands in September, because by the time the politicians take their photos in the White House ballroom, the harvest basis will be wide open, and the seasonal highs will be long gone. Defend your farm's cash flow today, strip the emotion out of your marketing, and let Wall Street hold the bag when the weather changes. Hit that like button if you appreciate the straight talk. Make sure you are subscribed to the channel, and I will see you guys in the next video.